Ladies and gentlemen, welcome to the Completing the Audit playlist right here at Let's Talk Audit and Assurance. And yes, it's still me, Christine, your auditing theory conversation partner, and I'm very happy to announce to you that we have finally reached the completion phase of the audit, my friends. And so in this playlist, we are going to talk about the finishing touches and how we tie up loose ends as we complete the audit process. So, also in this playlist, we're going to pay particular attention to the following items. We'll talk about litigations, claims, and assessments, subsequent events, the assessment of going concern, related parties, the management representation letter, and other procedures. Now, that might seem like a lot to digest, but trust me, it's going to go by in the breeze. So, shall we? Let's start with litigations, claims, and assessments. Of course, for this one, we would need to call back your previous recollection or perhaps previous lessons coming from financial accounting and reporting that talked about what are contingencies, contingent assets, contingent liabilities, and when should these be accounted for, including, of course, provisions for, say, for example, warranties and the like. So, from the viewpoint of the auditor, what we need to remember is that in terms of the identification and the accounting for litigations, claims, and assessments, the primary responsibility still rests with management. And because it is management that is primarily responsible for litigations, claims, and assessments, it would also make sense to say then that management is the primary source of information with regards to these things. Now, perhaps you would remember, hey, didn't we write or shouldn't we write a letter of audit inquiry to the client's lawyers or legal counsel? And to that, I would say, yes, you are correct. But then, whatever is the response of the client's legal counsel or their lawyers will simply serve to corroborate the information which we primarily got from management. Okay, now what about the auditor? What are the procedures of the auditor with regards litigations, claims, and assessments? With regards to our audit procedures, I would like to summarize it by IRT, or you may maybe say TRI, or whatever makes you remember these procedures better. So these are the common procedures performed by the auditor in evaluating management's assessment and identification of litigations, claims, and assessments. We start with letter I, and I think you'll be able to guess what this I is because this letter I is very popular as it is part of the big three. No, so inquire, inspect, observe. So this letter I would refer, of course, to inquiry. So the auditor will inquire of management, and you would notice in almost all, if not all, of our procedures here at the completing phase, we always inquire of management. But not only management, we also inquire of TCWG, and of course, as what we have previously mentioned, an inquiry via confirmation with the client's legal counsel. So primary source, management TCWG, legal counsel will corroborate the information. Next, letter R. Letter R would be for us to read. We need to read correspondences, communications, letters. We need to read the minutes of meetings. We need to read contracts, especially be on the alert for possible breaches of contracts, possible breaches of covenants. We need to read the permanent files because normally that is where we find the contracts, and the current files, especially when it comes to items or procedures that are used to test estimates, for example. And then, of course, we need to read news items to determine if there have not been any cases or legal problems that has exposed our client to liabilities. So we read. So we inquire, then we read. The third common audit procedure, of course, is to test the professional fees account, especially if you notice, for example, a sudden increase in the professional fees account. So you might be wondering, why is there a sudden increase in the professional fees account? And maybe in the process of your investigation and your inquiry, you will find out that it was actually because the client hired a lawyer or was paying their legal counsel to present them in a certain legal case. So test the professional fees account and test as well the reasonableness of accounting estimates because we do know in the case, for example, of provisions, these are products of accounting estimates. So these are the common procedures of the auditor with regards litigations, claims, and assessments. And would you guess it? That's it. That is what we need to know. Those are the most salient points that we need to remember for litigations, claims, and assessments. And we are now ready to move forward to subsequent events. So when we talk about subsequent events, we call to mind and we draw out here in our screen the timeline and the important dates that we would normally observe in the conduct of an audit. So, first, there is the financial statement date. Normally, we call this one as the balance sheet date. Okay, in our example, let us suppose that the financial statement date is December 31, 2023. So, when we talk about the FS date, this is the date of the end of the latest period covered by the financial statements. Because we do call to mind that it is possible to present comparative financial statements, right? But when we refer to the FS date or the balance sheet date, this is the date of the end of the latest period covered by the financial statements. Now, we know that while the FS date is on December 31, in this example 2023, it is not actually usual for the auditor to start immediately on December 31 or January 1, right? So the auditor will then determine the start of the audit, start of the field work. In this case, we have left it blank, but maybe you might want to imagine perhaps the client would say, yeah, we are ready, our schedules are ready sometime around end of January or maybe beginning of February. Okay, so let's assume that the audit started February 1, 2024. So the audit will always start after the FS date. Of course, there will be exceptions to that if, for example, the auditor decided to perform an interim audit. Okay, nonetheless, that's the start of the audit. Let's now talk about the management approval date. So the management approval date in our example, April 10, 2024, represents the date in which management has approved the financial statements together with whatever adjustments were made to the financial statements. We do recall it is management who is responsible for the FS, and so therefore, whatever adjustments the auditor will propose will remain to be a proposal unless management approves it. So on the management approval date, the management approves the adjusted balances, ergo the final financial statements. We have to be reminded that the management approval date may be earlier but must never be later than the audit report date. In other words, management must approve first before the auditor can date his or her report. In most instances, the management approval date and the audit report date are one and the same. So normally you would get to see the audit report date, for example, to be the same date as the management approval date. But in cases where they are not the same, the thing to remember is that management should approve first before the auditor can date the report. And ordinarily, the auditor will date the report as of the date of the completion of the audit, when the auditor has fulfilled or completed fieldwork and has already gathered sufficient and appropriate evidence. So that's the date of the audit report. Now, the date of the audit report may or may not be the same as the report release date, because it is possible for the auditor to date the report, say, April 10, but then give this to management or release this to management on April 15. So the report release date is different. The report release date in our illustration is April 15, 2024. This is the date that the audited FS with the given report or with the given audit report, no, or with the audit report is given to management and stakeholders. So if you can imagine, it's the release date. So it's possible for you to date your report and yet still keep it, still not yet give it to management. So that date on which the audit report together with the audited FS is given, released, issued to management, that is what we call the report release date. So we needed to run through this timeline in order for us to correctly identify exactly where or when the subsequent events will happen. According to our auditing standards, there are actually two descriptions, or not two descriptions, but two types of events that will fall under subsequent events. The first type are those which occur between the date of the financial statements and the date of the auditor's report. Okay, so if you can imagine, it will be between December 31 or January 1, 2024, up to the date of and then the date of the audit report, which is April 10. So the subsequent events occurring within this period is still part of the responsibility or the active responsibility of the auditor. Okay? In contrast with facts that become known to the auditor after the date of the auditor's report. So essentially, when you talk about the events that occurred between the date of the audit of the FS and the audit report and facts that become known to the auditor after the date of the auditor's report, both are part of subsequent events. But are you noticing the change or the difference in the terminologies? In this first part, we call them events occurring. But in the second part, we call these facts that have become known. Okay, so this will then lead us to think that perhaps there could be a difference in the auditor's responsibility in relation to events that occurred and facts that have become known. So let's take a look at the difference in the auditor's responsibility for this. In the cases of events occurring between the balance sheet date and the audit report date, then the auditor has an active responsibility to obtain sufficient and appropriate audit evidence regarding subsequent events. Imagine the audit report date as kind of like building a fence, or there's a fence to the audit report date. Everything that happened up to the audit report date, or all subsequent events up to the audit report date, the auditor has a responsibility to obtain sufficient and appropriate evidence about these subsequent events. That's why I would like for you to conjure or to think about images of an active auditor, actively obtaining sufficient and appropriate evidence about subsequent events up to the fence, up to the date of the auditor's report. Okay, because the auditor's report date sets the responsibility. It fixes the responsibility of the auditor. And since we have an active responsibility to obtain sufficient and appropriate evidence, these are the audit procedures that we will commonly perform for subsequent events. And I'd like to summarize them by IRR. Okay, so as you might have guessed it right, letter I still represents inquiry of management, TCWG, and the corroboration of legal counsel. Then we need to read the minutes of meetings, okay, to determine if there have been subsequent events that were discussed, and to read the latest available FS. So if in case you were auditing the year 2023, FS date December 31, 2023, and when you perhaps performed the audit, the client already had the first quarter of 2024 unaudited financial statements, then read the latest available FS. It might give you an idea about any events that occurred after the balance sheet date. And then review management's procedures to identify subsequent events. Because similar to litigations, claims, and assessments, it is also still management who's primarily responsible to identify the subsequent events. So as auditors, we simply review management's procedures that identify the said events. So again, notice for the events occurring between the date of the FS and the date of the auditor's report, we have an active responsibility to obtain evidence. Now, what about the facts that become known to the auditor after the date of the auditor's report? So if the date of the auditor's report is kind of like the fence, so what will happen, or what will be our responsibility of those items that occurred after we have dated our report? Have you noticed the change in terminology, even the change in the tenor, no, or perhaps in the temperature of how this is? It's more of like a more relaxed state, right? Facts that become known to the auditor. It would be almost like imagining that the facts should be the one to come to you. Okay, facts that become known to the auditor. Why is this so? Because we are reminded that actually the auditor does not have any responsibility to perform procedures after the date of the auditor's report. Because, like what we have said, the auditor's report date fixes our responsibility. Okay, when you date the report, that's essentially saying I am responsible up to this date. And so, therefore, we do not have any responsibility to perform audit procedures after that date. Supposedly, we could relax already after that date, right? But our standards are quick to point out unless, so kakabahan na tayo, no? Unless matters come to his attention that may affect the audit report. So while you thought that you could already relax after you have dated your report, that is not always the case, because when matters come to our attention, when we are made aware of events and facts that might affect, no, our audit report, our previously issued audit report, then the auditor's relaxation state ends. Because we do have to determine what will be the effect of this subsequent event to our audit opinion. And to this, we try to explore two possible scenarios. The first possible scenario being that there is a subsequent event that occurred after the report date, but thankfully, the FS was not yet issued. So if you remembered our timeline a while back, we dated the report April 10, but we still held on to the audit report and the audited FS, released it to management only on April 15. So what if you became aware of facts that occurred on April 13, for example, okay, after the audit report date, but before the issuance of the FS. So in this case, you still have the audit report. It is still within your hands. It's in your drawer. It's in your office. So what will happen to this? The auditor will take necessary action to first determine whether the event has been properly accounted for and disclosed. Because for all we know, the event was already properly accounted for and disclosed, right? However, if upon investigation we find out that it was not properly accounted for, then, of course, our usual steps. We ask management to amend. If management refuses, the auditor must modify their opinion. Okay, and the modification will come in the form of either qualified or adverse. We can't anymore give a disclaimer of an opinion because we already knew of the subsequent event. Okay, and we have already taken necessary action to determine if they have been properly accounted for, meaning to say we have performed procedures to determine if they have already been reflected in the financial statements. And so, therefore, if we request management to adjust and they wouldn't do so, we have to modify our opinion by giving either qualified or adverse. Now, in this case, this is, I would say, the lesser evil because you still have the FS. What will happen if the subsequent event was after the report date and after the issuance of the financial statements? Meaning to say, the audit report and the FS is already in the hands of the client. What will you do? So, similarly, we still take necessary action to ascertain whether the event has been properly accounted for and disclosed because we always give management the benefit of the doubt, right? If such adjustment is necessary, so if we deem that this subsequent event has not been properly accounted for, but remember, the report is already with management. So what do? We notify the persons ultimately responsible for the overall direction of the entity, meaning to say TCWG. We notify them to please do not issue the financial statements. Do not file the financial statements yet. Do not release it to your shareholders yet. Okay, so we will notify the persons ultimately responsible. Please do not issue the FS. However, if upon notifying, TCWG will inform you that, oops, we have already filed it, or we have already given it, or what if TCWG will not heed your advice and subsequently releases the said audit report and the FS, and to this we will feel very bad. So if that is the case, then it will be the auditor who will take action to prevent further reliance on the auditor's report. It's kind of like saying, TCWG management, if you won't take the necessary steps, then I will take the necessary steps. All right. But of course, to this, we normally consult or seek legal advice to ensure that we are not violating any of our fundamental ethical principles. But the idea being that we give management the chance, okay, to prevent further reliance from the report. But if they don't do it, then we will be forced to take action to prevent further reliance on the auditor's report. So this is what will happen if the facts that become known to the auditor occurred after the report date and after the issuance of the financial statements. Now, still within subsequent events, we also have to get to know the two types of subsequent events. There is what we call a type 1 subsequent event, which requires adjustment, and a type 2 subsequent event, which requires disclosure. So, what is the main difference between a type 1 and a type 2 subsequent event? So, if a subsequent event requires adjustment, this will then refer to events that provide further evidence of conditions that existed at the balance sheet date, meaning to say, as of the FS date, the condition is already present. Say, for example, if you can imagine a customer who has already been suffering financial deterioration. So the client has a customer who has been unable to pay, customer has been suffering, for example, financially, even if the client has already made a demand for payment, but then that customer was declared bankrupt only in the next year. Okay, but if you think about it, the condition existed as of the year under audit. So in that case, that is called a subsequent event requiring adjustment or a type 1 event. Other examples of these events would be settlement of litigation in excess of recorded liability. Meaning to say for example, as of December 31, 2023, the client has recorded a liability of 1 million, but then subsequently in January of 2024, the client actually settled it for 1.8 million. So, meaning to say the condition already existed at balance sheet date. And so, therefore, the auditor must propose an adjustment for the year under audit. Another example is, and this was actually the example we gave a while back, loss on uncollectible receivables as a result of a customer's deteriorating financial condition. Meaning to say, as of December 31, 2023, the customer was already suffering financially. And so the subsequent declaration of bankruptcy for this customer would necessitate an adjustment to the books because the condition was already present in December 31, 2023. Okay, as opposed to those requiring disclosure, subsequent events requiring disclosure are those that are indicative of conditions that arose subsequent to the balance sheet date. Meaning to say, if you take a look at the balance sheet date, December 31, 2023, the condition was not yet present that time. Let's give some examples. Issuance of stocks or bonds after the balance sheet date. As of December 31, 2023, the stocks and the bonds were not yet issued. So, therefore, if it was subsequently issued, say January 15, 2024, there is no need to adjust the balances as of December 31, 2023, because as of that date, it was not yet issued, really, right? Another example is loss on inventory due to fire that occurred in a subsequent period. So assume that your client has inventory amounting to 10 million that was recorded as of December 31, 2023. But then, say, God forbid, on January 5, 2024, the warehouse of the client was gutted by fire. And so, therefore, there are no more inventory left. But if you think about it, think about the heading of the balance sheet. XYZ Company balance sheet as of December 31, 2023, right? Meaning to say, as of December 31, 2023, there was still inventory because the warehouse was still there. There was no fire yet. The fire happened subsequently, January 5, 2024. So in that case, the loss of inventory will be a type 2 subsequent event, or that which requires disclosure rather than adjustment. And of course, to serve as a contrast to our previous example, the case of the loss on uncollectible receivable because of a major casualty suffered by that customer after balance sheet date. Meaning to say, as of balance sheet date, the customer was still financially healthy. The customer was still able to pay diligently and religiously. But then something happened to the customer in 2024. So, meaning to say, the condition was in 2024, not yet in 2023. So, the main difference between the two is for you to look at the condition. Okay, the date on which the condition existed. So if the condition existed as of balance sheet date, it will require adjustment. But if after balance sheet date, it will require disclosure. Okay. Now, subsequent events will also have an effect on the auditor's audit report date. Okay, so the auditor may consider using what we call dual dating. So in the case of dual dating, it will sound something like this. April 10, 2024, which is the original auditor's report date, right? Except for note 5, so we're referring to a note in the financial statements as to which the date is April 20, 2024. Okay, so that's one option of the auditor to dual date. Versus the auditor may also use single dating. And in single dating, the auditor will simply use the new date, which is the date of the subsequent event. So in this case, the auditor may date the report as of, for example, April 20, 2024. Now, the choice whether to do dual dating or single dating will depend on the auditor's willingness to assume more responsibility. Because if you notice dual dating, it says April 10, except note 5, which is April 20. That means the auditor is not responsible for the intervening period. The auditor is not responsible from April 11 to April 19, right? But if you look at single dating, the second example, the original report date has been totally removed, and so therefore, this means that the auditor is responsible up to April 20, including April 11 to April 19. So again, the choice whether to dual date or the single date is part of the auditors or will be considered based on the auditor's willingness to accept additional responsibility. Okay, so that will be for subsequent events. At this point, we are now ready to move forward towards going concern. Okay, the evaluation of going concern or going concern evaluation of management's going concern assessment. We have to be reminded once again that management's responsibility is to assess going concern. It will be management who will decide whether they are still a going concern or not. The responsibility of the auditor, on the other hand, is to evaluate management's assessment. That's why management has to assess so that we can evaluate that assessment. Okay, and this is a very important concept that we need to remember, okay, that we are simply there to evaluate management's assessment. So, in the process of evaluating management's assessment, we are also on the alert for material uncertainties. So, what are these material uncertainties? A material uncertainty exists when there are events or conditions that individually or collectively may cast significant doubt on the entity's ability to continue as a going concern. Highlight on significant doubt, meaning to say these events or conditions will not conclusively tell you that the business is no longer a going concern, but it will lead you to doubt whether they really are a going concern. Okay, so we are on the alert for material uncertainties. And these material uncertainties may come in many forms. And here is an example, or here are some examples as to what could indicate material uncertainty. For example, non-compliance with terms of loan agreements or other statutory requirements. Remember breaches of covenant, right? Pending major legal or regulatory proceedings, such as, for example, lawsuits, filed against the company. Say, for example, the possibility of being denied a franchise renewal. So that will also cast significant doubt. Or changes in legislation or government policy expected to adversely affect the entity. What if one day the government suddenly decides to put a complete ban on single use plastics? What do you think will happen to companies that manufacture single use plastics, right? So it could adversely affect the entity. Net liability or net current liability, when the liabilities have overshadowed the assets, or substantial operating losses even after having operated for a long period of time, inability to pay creditors on due dates. Because if you think about it, why is the business no longer able to pay its debts? So they probably, we might think that there might be significant doubt about whether they can still continue or not. Loss of a major market, franchise, license, or even a principal supplier. So these events may indicate significant doubt. Okay, again, material uncertainty, just significant doubt. We do not know for certain if this will mean that the business is no longer a going concern, but these are items that would warrant a disclosure in the notes to financial statements. Okay, so speaking of such, let's take a look at some possible combinations of um, events or circumstances. For example, management is the one who assesses going concern, right? So, what if management has assessed going concern to be appropriate? They have assessed that they are still a going concern, and the auditor agrees. Okay, going concern is appropriate, but then there is a material uncertainty. Okay, and when the auditor became alerted to the material uncertainty, the auditor then proceeded to determine if it has been properly accounted for and disclosed. So, thankfully, the material uncertainty is properly accounted for and disclosed. So, what will happen to the auditor's opinion? So, in this case, the auditor can still give an unmodified opinion, but within the audit report, the auditor will make sure to include an MURGC. Do you remember in the previous playlist that we had on audit reports, MURGC, material uncertainty related to going concern? So, for as long as the material uncertainty is properly accounted for and disclosed, we're good with unmodified. Just make sure there is an MURGC. But what if the going concern is appropriate? Okay, so auditor and the client agree that the going concern, the client is still a going concern. However, there is a material uncertainty But this material uncertainty is not properly accounted for and disclosed, and the client refuses to properly account for it. The client refuses to disclose it. What will happen to the opinion of the auditor? In this case, the auditor will modify the opinion, either qualified or adverse, because the auditor was already able to determine that there is a material uncertainty, right? So you cannot give a disclaimer of opinion. But the auditor may give either a qualified or adverse opinion. So notice, even if going concern is appropriate, but if the client refuses to disclose a material uncertainty that exists, this can still be a reason for a modification of the opinion. Another possible circumstance that you might encounter is the use of a going concern. Is for the auditor and the client to agree that going concern is not appropriate. Okay. So client says, sorry, auditor, we're no longer going concern. And the auditor evaluates and the auditor agrees. Yes, client, unfortunately, you're no longer a going concern. And then the client decided to use an alternative authoritative basis to prepare the financial statements. And this authoritative basis is disclosed in the notes. Okay, what will happen of the auditor's opinion? So remember again that the auditor and the client are both in agreement that the client is no longer a going concern. And then because the client is not anymore a going concern, the client did not use a going concern basis, rather used an authoritative basis. In this case, the auditor can give an unmodified opinion. Okay, because the auditor and the client agree. And it is correct for the client to use another framework since they're no longer going concern. But this time, the auditor must make sure that there is an emphasis of matter paragraph to highlight the fact that the client used an alternative authoritative basis. Do you remember in the previous playlist we talked about special purpose frameworks? And we said the framework being used should be disclosed in the notes. So if you want to highlight it, you will use EOM. So similar to this one. Okay, so we can still give unmodified, but then we highlight the framework used by the presence of an emphasis of matter paragraph. Another is it's possible that going concern is inappropriate, but then the client insists on using going concern. Okay, so upon evaluation, the auditor sees that it's not a going concern anymore, but the client is in denial, and the client would still want to use going concern. In this case, the auditor will give an adverse opinion because it is not appropriate to use a going concern basis. Okay. Now, it's also possible for management to refuse to make the going concern assessment. That's why at the very start we pointed out it is management's responsibility to assess going concern. The auditor will evaluate the assessment. And so therefore, if management refuses to make the going concern assessment, then the auditor will have to modify the opinion this time, either qualified or disclaimer. Why disclaimer already? Because the auditor cannot evaluate an assessment that was not made in the first place. It is necessary for an assessment to be made before it can be evaluated. So, if management refuses to make the assessment, there is nothing to evaluate. Therefore, the auditor was not able to audit the assessment. And with that, the auditor will give either qualified or disclaimer of opinion. And yes, that's all about going concern. We are now ready to move forward to related party transactions. Now, we have been talking about related party transactions for quite a while now. And when we talk about related party transactions, we always know that this one will deserve special audit attention from the auditor because of the required disclosures. However, as early as now, we are again reminded that it is still management who is responsible for identifying and disclosing these related parties. Please remember, according to your accounting standards, that disclosure is required for all related parties, and disclosure is also required for material related party transactions. So, in terms of the related parties, all related parties must be disclosed. But in terms of the transactions, only material related party transactions need to be disclosed. Now, because the auditor is not part of management, so it is not expected for the auditor to have the same level or to even surpass the level of knowledge of management, right? Because we are not in the business 24/7. We're not part of the of management. So, in the case of related party transactions, our responsibility is to have a level of knowledge necessary to be able to identify events, transactions, and practices that may have a material effect on the financial statements. But as to the actual identification and disclosure, again, that is still management's responsibility. Okay, so the auditor will be alert for indications of related party transactions. So these are transactions that will activate our spider senses and would make us might lead us to think that hey, there may be related party transactions here. So here are some examples of these indications. For example, if you talk about transactions which have abnormal terms of trade, can you think about getting a long-term loan and not being assessed interest for it? Or transactions which lack an apparent logical business reason. Like per your assessment, per your evaluation, it just doesn't make sense for your client, for example, an educational institution, to purchase a brand new helicopter, right? Because what for? So therefore, this might be an indicator of a related party transaction. Or transactions in which substance differs from form. Or transactions processed in an unusual manner. For example, if you have noticed that there are special arrangements being made, well, normally we give special arrangements for people we are related to. So, in the case of our client, that might also indicate the presence of a related party transaction. Or in the case of high volume or significant transactions with certain customers or suppliers as compared with others, or even unrecorded transactions such as the receipt or provision of management services at no charge. Because why will they agree to giving it for free? Most likely because they are related, right? So again, these are indications, just indications of possible related party transactions, which will help us evaluate if the related parties and the related party transactions identified and given to us by management is complete. Okay. So, with that, we are now ready to move forward to management representation letters. And for this, we have to recall that there are two types of written representations by management. There is what we call general representations, and the general representations would refer to management representation on the premise of the audit. The premise of the audit would, of course, invoke management's responsibilities not only for the preparation and presentation of financial statements, including the design, implementation, and evaluation of internal controls, but also to making sure that the auditor is given unrestricted access to records and people necessary to conduct a satisfactory audit. So those belong to general representations. However, there is also what we call specific representations. And in the specific representations, these are the representations regarding specific assertions on the financial statements. Okay. Now, if management refuses to give a general written representation, then this can be a basis for a disclaimer of opinion. Because remember, under the general representation, management acknowledges the responsibility. So if management does not acknowledge the responsibility, do not give an opinion, right? To be fair, right? They have to acknowledge that they are the one responsible. If they won't acknowledge, then we won't also give an opinion. However, in the case of specific written representations which management refuses to give, then the auditor will evaluate the effect of this missing or absent specific written representation and modify the opinion as appropriate. So we cannot yet tell what particular opinion we're going to give, if it's qualified or disclaimer, because we don't know the extent of this specific of this absent specific written representation. So in this case, the best we could do is to say modify the opinion. Now, part of the representation letter will also be for management to acknowledge that the unadjusted differences or the adjusting entries that they have chosen not to book, okay, or not to adjust are immaterial. So management must also acknowledge that, reminding us once again that when we prepare adjusting entries, we simply propose these to management. Management may decide to adjust all, and in that case, we'll be very happy, but they may also just decide to adjust some. Okay, the idea being that the remaining adjusting entries that were not booked are not material. So management has to acknowledge in the representation letter that those unadjusted differences are not material as well. All right. Now, some basic elements to the management representation letter. Well, first, it is to be addressed to the auditor, okay, coming from management. So, generally, it would take the form of a letter addressed to the auditor, signed by the members of management who have primary responsibility for the FS and primary responsibility for the entity. That's why normally it's the CFO and the CEO. Okay, the CFO representing primary responsibility for the FS and the CEO representing primary responsibility for the entity. Now, this letter is ordinarily dated the same date as the audit report, and it is part actually of audit evidence, but it is not a substitute for performing audit procedures. So say, for example, you have a specific written representation where management acknowledges that all the cash reported in the books are owned by us, and no other cash accounts owned by us are present, for example. And then you would say, oh, that already addresses the assertion of rights and obligations and completeness. Maybe I don't need to do any audit procedure anymore for those assertions. So that is not correct. While it is part of our audit evidence, it is not a substitute for performing audit procedures. Okay. Now, ordinarily as well, the management representation letter in practice, while it is signed by management addressed to the auditor, ordinarily, it will be the auditor who will determine the completeness of the management representation letter. That is why, in practice, the auditor drafts the management representation letter to ensure that it includes everything we need and want to be included. So sometimes the management representation letter or the written representation may also come in the form of minutes of meetings, for example, or a letter by the auditor then signed or acknowledged by management. Okay, but ideally, again, it should come in the form of a letter addressed to the auditor, signed by management, and dated the same date as the auditor's report. The alternatives we have mentioned are just that, they are alternatives. Okay. Now, other procedures that we will be seeing as well in the performance of or in the completion phase of the audit. So, yay, we're already in other procedures. And for example, this is where we will get to see the performance of the final analytical procedures, right? We give the financial statements using the audited values, one final run through of relationships, plausible relationships, to check if there are no other unexpected relationships that have been left or that were not yet investigated. So this is also where we draw conclusion from the working papers, of course, as a product of the review, evaluate the overall financial statement presentation, including the use of the proper line items, use of the proper terminologies and accounts, as well as the appropriateness and sufficiency of the disclosures made. This is also the part under the completion phase where, of course, we need to obtain approval for the financial statements. Management will have to approve the financial statements before we even agree to dating our audit report. Okay, we also review other information. Do you remember other information? Our responsibility is to read the other information. So review other information or documents that contain the audited FS and communicate with management and TCWG the scope of the audit and other matters of interest to the client. So these are already our wrap up procedures, so to speak. Okay. Now, as part of the auditor's internal inspection program, it is possible that upon internal inspection, the auditor discovered that there was an omitted procedure. So we call this one subsequent discovery of omitted procedure. And I know you can just feel the panic, right? That there was a procedure that was not performed. So in this case, if there is a subsequent discovery of an omitted procedure, the auditor must first determine was the procedure important? Because for all you know, it wasn't important, or there was already an alternative procedure that was done that addressed the same objective or assertion. Okay? But if deemed important, if the omitted procedure was so important that it could lead you to no longer support no, your original opinion, then the auditor should undertake to apply the omitted procedure, or if you can no longer apply the omitted procedure, an alternative procedure. So endeavor to apply the omitted procedure or the alternative procedure promptly, immediately, as soon as possible. Okay, so If upon applying them there were no misstatements, then we can breathe a sigh of relief. However, if upon applying the procedure, misstatements are detected and management refuses to amend, then of course we will be having quite a bit of a problem. So in this case, we have to review our responsibilities, including whether it is necessary for us to modify our opinion, to retract and modify our opinion. Okay, this is assuming management refuses to amend. That's why it's very important for you to choose your clients wisely. Okay, so of course, if management amends, then we wouldn't have any problem again, right? Now, if management refuses to let you even apply the procedures, so when you inform management, I have to go back because I wasn't able to do this one. I wasn't able to perform confirmation of accounts receivable. And management just flat out says no, and then you said, okay, I will not anymore perform confirmation. I will just test the supporting documents, okay, to prove the existence of AR. And then management still says no. So if management refuses to let you apply the procedures, then you go right ahead and seek legal advice. All right. So that's it. Those are the things that are necessary, or those are the salient points under completing the audit that we must remember and that we must recall. So thank you so much for joining me in this playlist. While there is only one video for the lecture or the discussion, we do have a special segment for the multiple choice question in this playlist. So if you want to apply the concepts we have just reviewed to MCQs or multiple choice questions, then I invite you to join me in the next video in this very same playlist. So thank you so much once again, and good job, everyone.